Hello, everyone. Hopefully you're having a good day. My name is Andy. My channel is Finding Value. And if you guys are looking for undervalued investment opportunities or looking for some more financial education, click subscribe. Love to have you in our community. So we've got Cathie Wood. I was scrolling through the comment section. People talking about Cathie Wood. They're talking about the big risk is deflation, not inflation. So here's an article. I'm going to go over it and I'm going to do a rebuttal. So here's Cathie Wood. She says the big risk is deflation. You go through here, you've got good deflation. Good deflation, what she defines that is, treasury yields are not moving higher because the bond market's now seeing three sources of deflation, according to Wood. It says first, bond market investors see what Wood called good deflation coming from innovation that spurs an economic boom. Wood cited several examples of good deflation she expects from innovation strategies. Advances in DNA sequencing can lead to lower healthcare costs, impacting prices 20% of the economy, potentially bringing deflation to the healthcare sector, where costs have risen steadily over time. She also says healthcare costs declined 40%. We are only in the early days of cumulative doubling of DNA sequencing. Advances in battery pack capabilities are another example of good deflation. Wood said for every cumulative doubling of capacity in battery packs for electric vehicles, costs drop 28%. And then she goes into saying artificial intelligence is going to permeate every sector, every industry, every company. And then she says bad deflation, that's basically the creative destruction of companies that fail to innovate. Commodity prices, and this is the one that I think people were worried about because we do have investments in commodities. And this is what she says about commodity prices. The third source of deflation will come from falling commodity prices that will take place as early as the end of this year, maybe next year, Wood said. We believe that there's a lot of double or triple ordering taking place right now, she said. I think supply chain management systems are getting better, or maybe it won't be as bad as it has been historically. Wood expects inventories to build to a level where well above demand sometime next year, and that the unwinding of them will cause an unwinding of commodity prices. She cited the soaring breakout of all-time high in the price of copper from its 15-year trading range is an example that commodity prices that are vulnerable to a correction. Wood acknowledged her investing strategy based on future deflation comes with risks. If we are wrong, then we will be perhaps uniquely wrong, Wood said. Even so, the reward can be greater. At these times, if you do take a stand differentiated from the crowd, for a good reason, and not just to be a contrarian, the payoffs can be enormous, she noted. We do think the bull market has broadened out, and we look forward to innovation rejoining the party once again. Basically, technology stocks. And of course, Tesla stock, even after Wood said in March that she thought Tesla shares could hit $3,000 by 2025. I mean, that's a perfect price target. All right, so she's saying that we are in a bubble. Not a bubble, but prices will pull back in commodities. So what would I have for a rebuttal? Well, I created a presentation. Why not, right? Here's my Cathie Wood presentation rebuttal to that article. Looks like I'll go down here. So I just snipped this from a couple of different articles. It says, U.S. housing market is nearly 4 million homes short of buyer demand. Housing inventory hits a record low, what it means for buyers. That was in February 1st, 2021. These were both in 2021. So what I am proposing, move myself back up here. So what I'm proposing is that the real estate market, residential real estate values is the driver of inflation. What she proposes is that technology will lower prices. Two vastly different things. Vastly different. And then she says that commodity prices were driven up by possible triple ordering. Okay. So I'm sorry. Oh my God. All right. Yeah, triple ordering. So my thesis, which I think is correct, but and I'll show you why I think that, is that the real estate market drives inflation. And the reason it drives inflation is because you have new homes getting new loans, which is an expansion of the money supply. inflation and deflation is nothing more than the expansion and contraction of the money supply, period. Prices do not enter that equation. That is a symptom. That is a symptom. Symptom. The way they measure CPI, so the Consumer Price Index, is a way to distort prices. It's a way that they can manipulate the inflation rate. That's why they do it. They focus all the effort to prices. The driver of prices is the increasing money supply. It has to be. You can't have prices go up with a decline. You can't have a broad price increase with a decline in money supply. Impossible. Well, hold on. You can have a decline a little bit if velocity were to kick way up. It's possible. But you can't have a entire group of prices go up, have a stable velocity, and then have your money supply go way down. So I'm proposing that we're going to see a kick up in velocity and an increase in money supply from real estate. And the reason it kicks up from the velocity a little bit or remains flat is because of the demographics and where people are in their human life cycle, their spending cycle. They're coming up. The millennials are a little bit larger demographic. They're coming up on home buying years, and they're going to have kids, and they're going to spend more money than what they used to. So they're going to make more. They're going to make more money. They're going to spend more money because of where they are in their life. So let's jump into the presentation that I've got. I'll shrink myself up kind of small and move me to the right. So here is, let's lose me. Here's the number of houses for sale in America. They have been declining. Decline. And what that means, what does that mean? What does the number of houses in America mean right here? It means that we aren't building enough homes and that the demand is so great that the residential real estate market can't keep up. That's existing. So the inventory is going to get completely eaten away. We're not building enough homes for the demand that we have. It's as simple as that. Next is this is our U.S. existing home months of supply. That didn't work. Right there. U.S. existing home months of supply. And then we've got this graph going here. Let me move me all the way to the right. Coming on up. This was the last housing market bubble. We had 10 months of inventory. And then we're coming on back down. And right now we're where the star's at about 1.99 months of inventory or lower, depending on where it is real time. We can see that when the demographic of the millennials and the underbuilt state from not building enough homes, new homes that is, ate through the inventory over time as this inventory decline. And then eventually it goes up in price. This is the natural case of what happens when a demographic is larger and you haven't built enough homes. It naturally eats through the inventory, pushing prices higher and eventually building more homes. This is natural. This started in 2011. You can see the inventory decline since 2011 steadily the entire time until we got to what I consider to be critical levels where prices started to really rocket higher. This was all predictable, and you could see this from 10 years away. 10 years ago, you could see this as we got closer and closer with the inventory declining, and people actually even called how long this would take roughly. They said 8 or 9 years before. And some even said 2016, the foreclosures would end, prices would start to move. They said approximately 30%, and then they would really take off. Alan Kendall called it to the T on YouTube. So there's that. Next, this is the new privately owned housing unit starts. And what this is, I've got some red lines. This is the yearly demand that goes across in the red line there. That's the yearly demand. I put in the red line the start of an expansionary phase. Red line is when this housing starts. The blue line crosses the yearly average and starts a new cycle, a new expansionary cycle of real estate. Here is our sell point for a commodity to S&P 500 ratio. It's when the housing starts crosses the average demand and goes below it. So we've got sell, sell, sell right at those three spots. Buy when it goes into an expansion phase. Buy when it goes into an expansion phase. It's right here, a little bit over the left. Buy when it goes into an expansion phase. That right there is where inflation comes from. It is between the red line and the blue and the yellow circle. And this one came down and came back up and actually ended completely right here because we had two large areas over the expansion phase where loans were happening. And then when they come down, you have recessions. So this real estate market, the demographic expanded over 2 cycles of real estate, basically. And they were short cycles. And then here was the 1999, 98 to 2007, 8 boom. And then the recession afterwards. So inflation comes from real estate expanding. Deflation comes from real estate contracting. The majority of commercial bank loans come from here. And if you have a implosion of credit, it stresses the bank. And then the bank doesn't want a loan. It has all sorts of problems. And right here on the far right, we're going into an expansion phase of real estate, which means it's going to be inflationary. We're probably going to see higher interest rates. And that's why Yellen slipped out. Well, maybe it's good if the economy had higher rates because they are not going to be able to control it. They know this is coming. And when you go into a real estate expansion phase, it's going to put pressure because of inflation on interest rates to go higher. And I don't know if they're going to be able to control the long end of the curve, the 10-year, 30-year type end. Now, this is those red, the yellow circles on this one are the red circles here. And then the green ones are the buy zones. The green ones correlate with these red lines. Those are buy ones. So red line here, red line here, red line here, yellow circle, right here. So I'm going to show you how it correlates to prices. This is pretty simple here. All right. I've got the chart on the right. This is the CRB index. Very simple here. I'll shrink myself up. You can see nothing underneath me. So this is CRB index. You can see the 3 phases, kind of a slow phase, a medium phase, and then a blow off top right there. Our buy points for the housing real estate market and the yellow circle. The yellow circle's here for a sell point, the beginning of the housing market, and green circle, the bottom of it, is this one right here. So we would have bought in here and sold here with our indicators of housing starts and the indicator of commodity to stock ratio. So the commodity to stock ratio said on this last one, 99 to 2008. 99 to 2008. And you would have seen this big move higher right here with the blow off top going from here to here. The next one in between this was a crash and a recovery phase. The crash and then the recovery phase. And the recovery phase is not a highly inflationary phase. Commodities don't do anything. They just go down. We hit the bottom here, COVID, and commodities are heading back up. We broke the downtrend line. So this could pull back in the short term, and it's completely normal for this to pull back. We've had a pretty large up move here, and it could pull back a little bit and then move on higher again. Similar to what this looks like here. See these guys and how they pull back? But we're in a real estate expansion phase. You still hold on. You don't sell. So she could be right that commodities do fall back down, but it's not because of the reasons that she gave. And that's important because it's going to pull back potentially. At some point it has to. And then we're going to move on higher because we're in an expansion phase of real estate. Expansion phase of real estate is inflationary. We are expanding the money supply. New loans against new homes. And inflation is a monetary phenomenon. It's not technology driven. Here is oil price. I put the same charts here. Real estate went up and was in the expansionary phase from 70 to 80 roughly, 2000 to 2008, and 2020 and on. And you saw increasing oil price, increasing oil price, increasing oil price right now, and we're breaking this downtrend line. She, I don't think, can be right for whatever reason, because when you break the downtrend lines, you are breaking massive chart patterns that are basically the market saying you're wrong, that prices are going to go up. On the very short term, I don't know which way this direction is going to go on the very, very short term. On the long term, expansionary phase, inflationary, prices going higher, the charts tell us that. They tell us that in the CRB index, oil's telling it. And this is the biggest inflationary hedge of any of the commodities. And we're entering a phase that we just broke a downtrend to the upside, and we're entering an expansionary phase of real estate. Every single time we've entered an expansionary phase of real estate, oil's gone up. Oil's gone up, oil's gone up. And in between these phases, the recession and recovery phase, oil didn't go anywhere but sideways. What does that tell you? That it's not driven by supply and demand of the actual commodity. That we can get oil quick enough to abate large price movements, very large price movements, quick enough. So the market is very efficient. What it can't do is that oil goes up when you get inflation, when the dollar goes down. The cycle is overlaid. It's completely tied together, the real estate cycle, expansionary phase, and commodity cycle. Here is the oil to gold ratio. Expansion phase means that the ratio is going to decline all the way down. There's our sell signal and buy signal. It kind of went off the chart there. And this was like 9 in 1973, 74. Here's the other one. It peaked at 30, went all the way down to about 6 is what it ended up at. Because I had to draw this in, but it ended right after this in 2008. It went all the way down to 6. Right now, we are at about 30, just under 30. We are at the beginning of a very large move in oil, in my opinion. Here is the platinum price behind me. Platinum price, and here's the phases. Expansionary phase of real estate. Came up, pulled back. Remember, it was one hump and then another hump. Came up, came back, and then blew up. Another expansionary phase, 99, 98, all the way up to 2008. Look at that move higher. We had a pullback here. Doesn't matter. It's going to go higher, all the way up. Then there's your sell signal right here. We threw a buy signal in 2020, and we should be buying platinum. It broke its massive downtrend right here. It broke to the upside. This could pull back some because it went vertical. So if it pulls back, it doesn't matter. We're still broken out of the downtrend. We're out of that pattern. We are clear. We're going to pull back a little bit and then rocket launch higher again because we're in an expansionary phase of real estate, which is inflationary. Platinum goes up during inflationary periods and outperforms gold. The platinum to gold ratio, that signals, they use that as a signal, some people, saying that the stock market's going to underperform commodities and precious metals. They use this indicator. And here we go. This is the silver price. I know we got a lot of silver bulls. I had to do it for silver. Silver and gold act a little bit differently than the other commodities. What happens is they start moving higher during an expansionary phase. The expansionary phase ends, they get a little pause, and then they do one blow off top right after, about 2-3 years after the housing starts to decline and you get like a recession. Same thing happened in 2000 to 2008, and then it peaked in 2011. So you get this kind of crash and then a big move higher. We are going to capitalize on this big time. Big time. This is going to be great. And now we're entering an expansionary phase, and silver's gone up. It broke out of its pattern here, broke to the upside here. We're going to have to break this big old pattern that's coming up. This is going to be this is going to be a massive move. Sorry. Massive move in silver, massive move in platinum. Going to be big. And this is the reason why I hold these things. It's this correlation between real estate land values, inflation, and commodities. I don't see how they could not be interconnected. So Cathie Wood is basically saying that this data is wrong, that technology is going to step in here and lower prices. But inflation is not prices. Inflation is the money supply increasing and that money going into things. Does that make sense? So you could have prices not go up a lot of certain things and have other things go way up. It's that inflation coming into the system. People determine where that money goes. So you could see everything go up. You could have, it could go into other areas. It could suck money into intangible assets, like I talked about in another clip, into Bitcoin and Ethereum and all these other things. It could go in there and not cause inflation of CPI numbers. But you still have inflation. You still have assets and things going up. It's out there. It gets sucked into different areas. So in my opinion, I don't think AI or technology is going to make a large enough leap in the time that she thinks for the actual production of commodities. And if it does, the commodity producers and miners that we are in are going to benefit from that technology. So I don't see that as being a negative in any way that you can think of it. I think they'll benefit with higher prices, and I think they'll benefit of some technological development, bringing their cost curves down a little bit. And we've talked about that before. I still think it's an inflationary period that's coming because of residential real estate land values and the expansionary phase, with the new loans coming against new homes in a fractional reserve lending system is going to expand the money supply. That's my opinion. My opinion will change if inventory changes on real estate. If inventory starts to skyrocket, I will change my opinion. At this time, it has not done that. Another thing, the forbearance moratoria coming on, I don't think it's enough homes to completely wreck this market. It can slow it down. It could slow the rate of increase. It can maybe stop the rate of increase. I don't think it's going to crash it out. That's my opinion on that aspect. And we'll monitor it as it goes. And these homes, if some of them come online, we'll monitor it and see it in the inventory. And we'll see how the market accepts it. If you guys like this video, give me a thumbs up, leave comments below, and thank you for listening. This is Finding Value.